This is Trepp with a special podcast, The Road to Recovery in Commercial Real Estate Finance. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And joining us today, Brian Stoffers, CBRE's Global President of Debt and Structured Finance and the 2020 Mortgage Bankers Association Chairman. We've invited Brian to our podcast today to talk about the recovery and get his insights on how it's progressing. Brian, welcome.
Thank you, Martha.
First, Brian, why don't you give us a quick overview of your background and experience?
Sure. So I started with the predecessor company to CBRE. It was called CB Commercial at the time, nearly 39 years ago. And I've been in the debt and structured finance business the entire time. We've gone through a series of mergers and acquisitions. I've been public and private 5 times since I started. And we now have a group in the debt and structured finance business. It's over 800 strong. It's a global business. We did about $49 billion in originations last year here domestically and another $6 billion internationally. We can now service a loan portfolio of nearly $240 billion. And we do business with many, many lenders. Last year, we closed business with over 360 different lenders on over 2,500 transactions, ranging anywhere from $500,000 to over $1 billion.
So from your vantage point, what is this economic outlook? Is business returning to normal soon? Is it, you've heard all the metaphors with the alphabet letters, V, L, W. What's your perspective?
Well, it's returning, certainly. We're thawing. I like to use an expression, thawing, but it's going to be a new normal. It won't be the normal that we remembered pre-COVID. I've been through 5 major downturns over the span of my career, and every one of them have been quite different in terms of the recovery, and I think this one will be as well. Unlike the great financial crisis of 2007 and 2008, which was caused largely by aggressive lending, whether it be residential or commercial multifamily. This situation was caused by a pandemic in an otherwise relatively stable commercial real estate market.
So from what you're seeing, what do you think is the long-lasting damage?
It's hard to say for sure. I think it accelerated some of the trends we saw pre-COVID in terms of retail. Certainly it caught lodging off guard. So the recovery phases of both those product segments will be different, and retail will likely never be quite the same. Lodging, it depends on the type of lodging we're talking about. The convention hotel business may take a number of years to regain its strength back to 2019 levels, while some of the resort destinations may come back sooner. We're already seeing markets in Florida and California that are drive-to destinations that have full occupancy on weekends. So it really depends. It's changing the landscape of how we're going to occupy office space. There's been lots of debate over that. Multifamily's held up rather strong, and lodging has really become the darling given the trends in e-commerce. So moving out of this pandemic, everything will be different than it was beforehand.
Brian, what would you say at this point? I know that there's been a slowdown and every market is somewhat different, but what would you call the drop in valuation or the increase in cap rates kind of by property type since the pandemic began?
Well, it's really hard to say because there's been so few trades. Most of the trades that were in process pre-pandemic have closed with minor to no adjustments, but there has been very little activity in the way of acquisitions since the beginning or the middle of the pandemic really took hold. So it's really hard to say. We do a lot of work globally, and some of the global markets we do business in have recovered faster because they got into the situation earlier than we did. And so we are starting to see some trends from a global perspective. And relative to core assets, there's been very little change in pricing. or cap rates, maybe up to 5% at most. When you go to core plus, perhaps the changes are more, and maybe that ranges from 5 to 10%. And then when you get to the value add or the bridge space in terms of financing, it's very, very difficult right now because of the situation relative to occupancy and supply chain, getting materials to do the rehabs, labor issues. And so it's a situation where the values of the high value add might have dropped more, the cap rates might have increased more, and perhaps that's 10 to 20 to 25% in a worst case scenario. So it really depends. We're going to have a lot more clarity as the markets continue to thaw, and we're really seeing post Labor Day as a time when a lot of the deals that are now teed up and ready to go to market are actually launched.
Brian, thanks for having me. Thanks for having us. How do you say that? Thanks for us having you. Thanks for being here.
Thanks for
joining us. There we go.
Thanks for joining us. There you go. The last time I saw you was from about 20 feet away. I was in the front row at the MBA conference out in San Diego. So you did a very nice job there with your introductions and A-Rod and everything else. After fumbling through all of that, my question was, do you see or have you seen, any sort of uptick on the lending side, or maybe less of a downtick on the lending side because of all of those, maybe potential acquisitions that were going to happen turned into recaps? Are you seeing any bright spots, I guess is the question.
Thanks, Joe, for the curveball. No pun intended. Yeah, we have seen some different trends. We have seen more recapitalizations as a result of the lack of sales and owners looking to monetize some form or fashion, recognizing that the sale market has been pretty tied up. But at the same time, right at the peak of the pandemic, we saw spreads blow out dramatically despite the lowering of treasuries and LIBOR, the indexes we typically price off of. And as a result, the markets froze, and we saw lenders of all types basically pause. And that's changed now. We've seen most lender types back in the market by and large. I can go sector by sector, product by product, or lender by lender, and there are variations on the theme, but by and large, most of the lenders are out there quoting again, albeit on average. I would suggest that the loan proceeds are down 5 to 10% on average. And the rates are pretty darn close to where they were pre-pandemic, perhaps up 25 to 50 basis points from that level. But they're still very, very reasonable.
As you said, Brian, you've been through 5 different crises. We know that the CMBS market itself came out of one of those crises in the early 90s. To throw you another curveball, as we come out of this, do you see percentages of market share changing as we get back to normal? When you compare lending from insurance companies, CMBS, banks, pension funds, et cetera, is there a new normal in terms of who comes out on top and who pulls back?
Yeah, it's interesting because we have seen over the span of time shifts. As you recall, 2007 was a peak year for CMBS when they originated about $230 billion of mortgages. And this year will be perhaps much less. I would suggest that it's probably going to be in the $75 billion range. So perhaps you would consider them at a net loss compared to last year's level. My guess is that the banks will, while they've got pencils down in terms of the major money center banks currently, that will shift at some point. We're seeing a lot of activity from the regional banks and credit unions that are finding their day in the sun right now. So that number will probably hold or increase somewhat. Life insurance companies hit the pause button like many other lender types. But I would guess that as they see relative value in commercial mortgages, their activity levels will pick up the balance of the year. Traditionally, life insurance companies are very active in the first half of the year and perhaps slow their pace a little bit as they fill their allocations. That hasn't happened so far this year. So I wouldn't be surprised to see life companies increase their activity levels, the balance, albeit again on conservative terms. And lastly, I would see that the agencies, Freddie Mac and Fannie Mae, have got ample capital to lend the balance of the year, and they're going to be very active for sure.
Are you, speaking of multifamily and Fannie and Freddie, I know CBRE has a very large footprint in that market. What was the feel among your people when Fannie and Freddie came out and really increased the reserve requirements and the debt service coverage ratio requirements and all the other kind of covenants that hadn't been in place before, when COVID came about?
Look, the agencies, Freddie and Fannie, were put into their positions to provide liquidity in an otherwise illiquid market. So they're doing exactly what they should be doing. They're doing it in a prudent way. When the occupancy levels were in question, in other words, how many of these multifamily renters would continue to pay their rent, they put into place these principal and interest reserves to protect themselves. And they tightened up on their underwriting. And now we've seen, so far anyway, renters able to pay their mortgages, probably due in part to the CARES Act. So as a result, they've started loosening up a bit, but they're still being judicious in how they approach it. So I don't think anybody can point the fingers at Freddie and Fannie to say they've been unfair about their underwriting standards, given what's gone on in the marketplace. We have seen more stress in the smaller loans in terms of requests for forbearance, but that's to be expected as well, because many of those smaller unit sizes, say projects with up to 20 or 30 units, are probably dealing more with workforce type tenancy and not white collar tenancy. And as a result, they've been more impacted by the situation of unemployment, and therefore they perhaps haven't been able to pay their rent. So we have seen a larger number of forbearance requests in that small balance space. But again, I think that Freddie and Fannie are doing a really admirable job of keeping liquidity levels up in an otherwise very constrained market.
Going back to underwriting questions, when you went into COVID, of course, you had your playbook that had been in place for years in terms of offices and how you look at credit and how you look at expiring leases and so forth. Now, when you have a situation where credit of the tenants themselves has become a real concern looking forward, and we don't have a lot of visibility in terms of what spatial needs will be perhaps 24 months from now in terms of expiring leases, how has your underwriting process changed? How has your playbook changed? And how do you think about this market going forward compared to where it was 6 months ago?
So Manas, are you speaking specifically around office underwriting?
Yes, I'm sorry, offices and more largely in places like New York, where so many people are working from home, and it's a savvy technological workforce that doesn't really have to be in the office day to day.
Yeah, so it's a topic of conversation for sure right now. There's one school of thought that suggests that work from home will become a more permanent fixture in office buildings, and therefore reduce demand. And there's another school of thought that makes a lot of sense, that more space will be required per employee. And so perhaps those two balance out. There's thought about high rise versus suburban low rise, and the fact that if you're in a high rise, how long do you have to wait for the elevator? And if you only put 4 passengers in an elevator cab, how long are you going to wait in line? All these sorts of things that are being sorted out. I think it's a little early to tell. I think there was probably initially a knee-jerk reaction that would indicate that office was really going to struggle for a while. I think that's fading. We're seeing that fade in countries abroad that have returned their workers to the office space. But I think we still have to wait and see how it plays out here to some extent. As far as the tenancy is concerned, we've always been pretty judicious at underwriting the credit behind the tenancy of a building. Probably more important with single tenant buildings or buildings that only have a couple of tenants that occupy the entire space than it is in a, broadly speaking, multi-tenanted building. But we do look at that as well. And there's still an appetite for office lending. I would say that it's become more neutral than well sought after. I think the appetite is looking very carefully at the sponsorship, the location, and the tenancy, probably more now than it was, say, in February.
Do you have any indications thus far about the geographic impact and which areas nationwide across various property types? I know in lodging, you talked about driveway destinations, already showing green shoots and so forth. But, more broadly, do you see some parts of the economy coming out of this better than others?
Yeah, it's surprising to me, and this is more personal view than anything, but it really depends on the state and the government involvement in those states. And in some places, like where I live in Texas, you've seen Governor Abbott take a more aggressive approach, perhaps, in terms of wanting people back to work versus some areas that perhaps are a little bit more conservative. And so I think it's more the state-run operations that are indicating who's going back and who's not. Now, as a firm, I think we're being very judicious. And in fact, we're writing the playbook for a lot of Fortune 100 companies right now and how they get back to work and the protocols that are in place for cleaning and for spatial content and coffee machines and all sorts of things that we used to take for granted, but it's all going to be different now going forward. And so I do think that office underwriting as a result will be looked at very carefully. The other impact we really haven't talked about is agile space. And the majority of space taken in places like New York and London over the last couple of years has been with some of these agile companies that are somewhat in question. Their business models are in question. And so I think that's something else we're going to be watching very carefully in major cities and some secondary cities where those same tenants occupied substantial amounts of space or took down substantial space over the last couple of years.
Those might be converted into quarantine areas or temperature scanning areas or disinfectant, like a drive-through, but it's a walk-through.
Yeah, who knows? Testing area. We have seen a number of hotels close and are going to be remarketed as multifamily units going forward where there's a shortage of housing. So yeah, again, we're going to come out of this with a new normal.
You were talking about forbearances, and I believe you recently coined the term forbearageddon to describe the current wave of forbearances. What's the impact to investors?
Yeah, so I can't take credit for that word, frankly. I heard it somewhere, but I thought it was an interesting expression for forbearageddon. The impact to investors varies. So with the agencies, because they're under government conservatorship, they were both mandated to provide forbearance to owners of multifamily properties that were affected with tenants that were affected by COVID. So it was kind of a chain reaction. And frankly, there wasn't a lot of scrutiny around the tenancy side of it. If a tenant said they had COVID or were affected by COVID somehow, they were allowed to not pay their rent for a period of time and then make that up over the ensuing 12 months. And then if a landlord was impacted to a large degree, then Freddie or Fannie would allow them forbearance. Back to your question, impact on investors. So with the Fannie program, the DUS lenders, of which we're one of, are required to provide payments to the bondholders for any forborne loan. We're pleasantly surprised that most of the institutional business we do has resulted in really strong borrowers who are able to continue making payments, who haven't been dramatically impacted by tenants not paying their rent. Same holds true for Freddie Mac. But as I mentioned earlier, we have seen more forbearance granted to small balance lenders, say averaging 2.5 million. And as a result, investors are getting paid directly either by the servicer in the case of Fannie, or in the case of Freddie, investors are paid by the master servicers, which are 3 major banks in the US. So the impact to investors has been nil as a result of forbearance there. Now, with respect to life insurance companies, they manage their own books. I would say that life insurance companies have been very reasonable in dealing with borrowers affected by the COVID situation, who have tenants who can't pay their rent, thus they can't pay their mortgage. And so they have had very constructive conversations with those borrowers. In some cases, there's plenty of cash flow anyway to continue paying rent, so the forbearance hasn't been granted or hasn't even been asked for. We're telling borrowers, if you don't need to ask, or unless you have a game plan on how you're going to work through the situation, don't go to your lender with a what if, if I can't pay, what are you going to do? But have a constructive conversation. Now, moving to the banks, I think part of the philosophy of banks is they're getting essentially free money from the Fed right now. And I think the Fed has been suggesting that they be accommodative to their borrowers. And so the big money center banks, very constructive conversations with their borrowers that we've seen. How long will that last? It's hard to say, but we're saying that we're thinking that it's going to last, at least 6 months. So we haven't seen any guns drawn, if you will, in terms of standoffs between lenders and borrowers that way on the bank side.
Going back to the demographic issue, you were talking before about how your colleagues were spending a lot of time with potential office lessees, talking about spatial issues and how to use the elevators more efficiently and coffee machines and so forth. There's a lot of talk about big demographic issues on the multifamily side, people fleeing the cities for more space in the suburbs. Same thing with offices, trying to get more suburban office space, perhaps greater diversification by offices so they don't have nearly as much concentration in one area. Any early indications of whether these are kind of urban legends or whether they may come to fruition over time, or even a gut instinct as to, what your years of experience have told you will happen kind of coming out of this?
Yeah, I think it's possible we'll see more of what we call hub and spoke activity, where major office in downtown core area, for those that don't want to commute in every day, perhaps there's some satellite offices, or maybe even some different forms of agile space in the suburbs where employees can check in and work when it becomes quite difficult for some of our employees who have young children and young families to get their work done or have the quiet space. And so I think that's the distinct possibility that we will see some return, whether it's big numbers or not, yet to be determined. But I do think we'll see some migrate into those satellite offices. But it is a little early to say definitively.
Brian, I'll give you one of your leasing guys a lead. I have been saying on the podcast for weeks, I am pushing very hard for, instead of one office in Midtown Manhattan, we have an office in Westchester, in Jersey City, and in Long Island City. That way I only have a 5-minute drive to work. Maybe it could be like a Regis type office or a WeWork even. Well,
right.
Not really a WeWork, but
that may be the next trend. I doubt you're going to be working 3 feet apart from the next person. My guess is it's going to be a different kind of spatial layout if you end up in that situation. But I think that's entirely possible. Maybe some of these hotels are converted to satellite offices in the suburbs.
That's right.
Imagine it's the reverse of everything we've been talking about for the last 10 years. Right?
Well, it could be a
Everyone moving to the
panacea.
city, everyone moving to the multifamily, nobody wants suburban office. All these kind of tenets that we've been talking about for so long are potentially reversing. But I think there's a clear potential too that in January there's a vaccine and everyone it takes 3 or 6 months and people forget about this and they just go back to their regular life.
I don't think people are going to forget about this anytime soon. This is one of those life-changing events. I tell our younger professionals that have never experienced a downturn, that got into the business in say 2009 or 10. They've been in business for a decade and never seen anything like this. They will never forget this, I promise you.
Yeah.
You guys are always, we always say that Manus is the glass half empty guy and I'm the glass half full guy. So I have to play my role on the podcast, you know?
Yeah, I'm a glasses half full guy too. I'm an intermediary.
Well, Brian, you have a big staff working with you. Obviously, I would imagine that there's a lot of business travel involved with your team, going out to see borrowers and so forth. When do you see business travel picking back up again for your team, and to what degree? Or is there a new normal coming out of there where business is just conducted by phone, by Zoom, and, you know, the 3 Martini lunch was retired, you know, a couple decades ago, but you know, the Smith and Walensky dinner still exists, and the Peter Lugers and things like that. But in the new normal, you know, our thesis has been on the podcast a couple of times that 12 months from now, you still may see only 25% of business travel taking place. Do you have a thought on that, or are you guys itching to get back on the road and do business, or is that still way far off?
There's no substitute for a good steak dinner and an in-person meeting. This bottle of wine, we all long for those days again. I travel nearly 300,000 miles a year and 47 weeks out of the year. And so I have to say, I miss it. I miss the cultural interaction of getting into our offices. But I do think the new normal will be less business travel, less business dinners. I've lost quite a bit of weight through this because I haven't been eating out. And so there are some silver linings to this. So I do think it will be different. I think about the global travel and, you know, the 20-hour trips to get to the Middle East or to Australia or wherever you're going. And these Zoom calls and podcasts have been pretty effective. So I do think it will change. I sure hope that we don't see the precipitous drop that some are predicting that really change some major industries like lodging and airline and restaurants, but we'll have to see.
You may have to send some of your prospects, you know, the Omaha steaks and a nice bottle of wine and just do it over Zoom, right?
Well,
that might have to be the new
wine
normal.
Consumption is up dramatically during this COVID crisis. So I suspect the liquor stores and the mail, I would almost use an obsolete term, mail order, the web-enabled wine ordering.
Right.
It's changing forever.
Yeah, the business travel really is such a concern for us, for the hotel industry, like you said, that just between business travel, you know, overseas vacation travel destinations like Hawaii and other places, and conference destinations, you know, if that is only coming back at 25 or 50% of normal, that's a scary prospect for some of these destinations. So something we're watching very carefully.
I agree. Think about the convention trade and the money, the tens or hundreds of millions of dollars it brings to cities, and supports the restaurants and the tourism industry. That's a major concern. And
it wouldn't have been the same if you had A-Rod on the Zoom, as opposed to sitting next to him at MBA. It wouldn't nearly has been as enjoyable for the audience, I don't think.
It would be near the same. I did interview Bob Woodward on Zoom a few weeks ago and had a thoroughly enjoyable conversation, but we had some real technical difficulties the first time we filmed it, such that we had to scrap it and do it all over again. So you can't do that live. You got one shot and you're done, but we were able to redo it on Zoom.
So Brian's going to be our new booking agent, I think. He can get a lot better. He can get all these incredibly famous guests. Not that you're not incredibly famous, Brian.
Oh, no. I'm just a pauper, but I've got the Mortgage Bankers Association staff that does the heavy lifting there. They're terrific.
I'm not sure those celebrities are relevant to our listeners, but
What? A-Rod owns like 6,000 multifamily units or some number like that.
yeah, I'm skeptical.
Anybody that's interesting, they don't have to be commercial real estate related. We can always bring it back to commercial real estate somehow.
That's right. There's always a connection there.
You're always sitting somewhere when you're doing the podcast.
Well, yeah, we'll explain that to the board. And so, the Fed signaled that they were going to keep rates near zero until 2022. And CBRE puts out a lending momentum index, and this Q1 index was up 4.5%, which showed that loan closings were pretty healthy in the first quarter. What's it going to look like in Q2? We know that loan closings went down. Any idea?
Well, look, there was some carryover from Q1 that closed into Q2 that closed in most cases as applied for. So credit to the many lenders we closed with that they stuck to their terms. But no question that things did slow down. The physical inspections, the engineering reports, the pause in lending because the rates were going wacky, the spreads were blowing out so quickly, is definitely going to have an impact on Q2. But there's still money out there. And again, here we are in the middle of June, and we do see good signs of thawing. So I'm optimistic that things will continue to pick up. We need the sales market to return in order to get back to even healthier levels that we were used to perhaps before the pandemic hit. But we're looking for an upward trajectory. And you asked about the shape of the recovery. There's every different description I've heard. The one I like most is probably the bathtub description. It's down low and it stays low for a while, but then it starts graduating back up again. I'm not sure that's the right answer. I think there's elements of the economy that'll have more of a V shape. And I think there are elements that might be more bathtub shape. So we'll see. But the good news is on the lending side, things are getting better. Just in the last 2 weeks, we've seen overall rates to borrowers contract by roughly 50 basis points. And they're now in the mid threes, in some cases below 3. So that's a big change from where they were just 2-3 weeks ago. Again, though, the underwriting is a little bit more conservative. There might be principal and interest reserves. And as a result, the proceeds are not what they were pre-pandemic.
Brian, do you have a sense that the U.S. economy needs another stimulus at this part? You said earlier that you thought that people keeping up on their rents was partially a function perhaps of the first stimulus. Do you think, or maybe I should turn the question around, if there isn't another stimulus, do we see things head south, or do you think the economy has enough oomph at the moment to kind of get by with what we've gotten so far?
It's hard to say because the CARES Act, $600 stimulus per week, largely benefiting those unemployed that are more workforce oriented. I do worry a little bit when that ends at the end of July. I know the administration is trying to think about a version 2 that would encourage more people to go back to work, because facts are, some people are making more money unemployed than they did working. And so I get that philosophy, but until the economy shows a sustainable recovery, particularly in some of these hard hit industries, I do think they are going to have to come up with some other plan to help along the lines of the CARES Act. Relative to businesses, I'm pretty excited to see the Main Street lending program be enacted. I think it's going to help a lot more companies that need the help. Now, it's a loan program. It's not a forgivable loan. It's something that has to be repaid over 5 years. But that program shows some really promising signs of helping some of the hard-hit areas like perhaps restaurants or hotel owners that can use some of the proceeds from this to make their mortgages. So the answer to your question, Manis, is I do think we need some more to kind of get us through the next valley, if you will, and then hopefully from there on, it's something that is sustainable without support. I worry, frankly, about my kids and grandkids when and if we have them, paying the price that is going to have to ultimately be paid for this massive deficits we're running. And I know some are of the opinion that multi-trillion-dollar deficits don't matter, but I was raised and schooled to think that debt does matter. And I do worry about the hole we're digging.
Don't worry, Brian, we'll take care of it.
You're younger than the rest of us, Joe.
I'll just brush up on my modern monetary theory reading and just, have the next chairperson just have the mint print the heck out of the cash, and we'll be all set.
Joe, this
I'm
isn't
crossing my
monopoly.
fingers.
We're dealing with real money, not monopoly money here.
Yes,
Well, are we?
it is scary. It is scary, and unlike maybe 10 years ago or 15 years ago, there seems to be no desire for discipline. You know, there seemed to be some budgetary hawks 15 years ago that were really keen on, you know, either a balanced budget amendment or at least limiting deficit spending, and that entire demographic within Washington seems to have left the building.
Well, it's interesting because, as you know, man, as a decade ago, the Republicans were really on the bandwagon to reduce the deficit. In fact, we saw it reduce substantially. The Democrats were the spenders. And then about, I don't know, 4 or 5 years ago, it flip-flopped, and the Republicans became the spenders, and the Democrats were the hawks. And now they're both the spenders. So
Right.
God help us. So.
Right.
If we look at your new business pipeline, what does it reveal about where the market's going to come back?
So it's already, it never slowed down relative to multifamily and logistics. I think office has room to improve. Retail, boy, we've got to get the service economy up and running again. Get the nail salons, the hair salons, the restaurants, all back to some degree in paying rent for that retail. So hopefully that retail has some upside. And then obviously lodging, as people feel comfortable traveling again, or perhaps businesses feel comfortable sending attendees to conferences and business meetings around the globe, then that's probably the slowest to recover, frankly, is that lodging business.
You talked about changes in business travel. Is the pandemic likely to change the way business gets done in your world outside of that? Do you use different technology? Do you close business differently?
Yeah, I've never been on, so I didn't know what Zoom was before the pandemic. And I think all of us know what Zoom or GoToMeeting or these different tools, you know, how effective they really can be. So, you know, that's changed. We are using a remote notary now in some states. And I think at some point, all 50 states will have that legalized, if you will. And there's some workarounds now. I think the way title insurance is handled is changed and probably advanced somewhat. We have been able to successfully remotely close loans that used to be done in a centralized facility. Same with loan servicing. We had contingency plans for our loan servicing employee base of nearly 150 employees that service our $240 billion portfolio. But particularly since we're headquartered, this business anyways, in Houston, and our servicing is headquartered in Houston, we prepared years ago contingency plans in case a hurricane knocked us out of our building, whether it was a power failure or otherwise. And so those plans have really come in handy during this pandemic, because not all, but almost all of our servicing staff are able to very successfully work remotely. And as you've probably seen, the productivity stats are actually up, and we'll see if that continues as people start returning to work, and you know, they have more things to do, more places to go, more time to spend on commuting.
I know we've seen that in our personal experience, so we'll see how it goes going forward. I noted that CBRE has numerous recognition. In fact, one just today I saw was announced that CBRE is of the top 100 best corporate citizens. So that was just today. Also has most ethical gender equality index and most admired. Trepp has begun to incorporate environmental, social, and governance metrics and measurement into its analytics. So factors such as this. Do you see investors or borrowers asking for this type of information?
Well, yes, they're asking for it. Let me start by saying that CBRE's done, I think, a magnificent job in becoming more diverse, starting at the board level. I believe our last 6 board appointees are all diverse candidates, whether women or people of color. So we've changed a lot at the top of the house, and it's an absolute priority in terms of diversification, particularly given what's taken place the last several weeks with the George Floyd tragedy and the ensuing discussions. You ESG is on everyone's mind, but frankly, I don't see investors paying up for it. I don't see lenders offering lower rates because of it. I don't see tenants necessarily gravitating towards it, although I think that can and probably will change going forward, particularly in the office environments. My guess is more tenants will ask the questions about the type of air circulation, the type of greenery, the type of cleaning that takes place in these office buildings. So I do think that's going to become more of a focus, but I go back to the LEED certifications that were very popular and still are in many buildings. And we just didn't see a lot of attribution in terms of lower cap rates or higher rents that were being paid for those buildings. Now, that's not to say that some tenants didn't require those certifications. They might have, but I don't know that many of them, paid a quarter more per square foot in rent because of them.
As somebody that once had a roommate, an office roommate that was a smoker, I am grateful for all the progress we've made over the last 25, 30 years. So it wasn't a great way to start my professional career.
I still want to get rid of the nail clipper, the office nail clipper. That's the new version of the smoker.
You had to go there.
Well, what's interesting is that we got away from eating our lunches at our desk because that wasn't sanitary. And now the go forward strategy is they don't want anybody eating in a group environment. They want you eating at your desk.
Yeah, I've always been a fan of the lunch table and not al desco. I know Keegan's an al desco type guy.
He is. So with that, we'll close the special podcast. Thank you to our guest, Brian Stoffers. Thanks to our producer, Keegan St. Ange. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question, send us an email at podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the Trepp Wire podcast with your favorite provider. Thank you for listening.